Thank you so much for coming. My name is Andrea Minelli. I'm a senior advisor at Titan Partners, and Titan Partners is a global firm focused on education strategy, consulting, and also investing. So we do both counsel and capital. And we work pre-K to gray, and we work with all kinds of investors, mission investors, philanthropists, traditional PE, venture capital, but we work mostly with companies, with ed tech companies who are at growth inflection points and need help. So that's the Titan infomercial. I just wanted to give you context. I'm joined today by a really deeply experienced panel of investors, and we're going to let them talk about themselves and tell us whether they call themselves impact investors. The reason we're having this panel, the title, Building a Mission-Driven Cap Table, it is particularly targeted at entrepreneurs and how you get alignment with your investors in terms of creating a partnership that drives outcomes. So that's going to be a big topic today as well. You could say impact investing has been all the rage. We had a series of global crises, whether it was climate, whether it was COVID, social inequities, that had really brought impact investing to the forefront. Impact investing as a term has been around for 20 years, though. It was coined by Rockefeller Foundation in the aughts. So we're going to explore a little more deeply what it is, what does it mean to invest with impact, and how do funders and entrepreneurs get alignment. We're going to close with a little bit of advice, and maybe if we have time, because it's a nice sized group and we have a lot of entrepreneurs here, with a question or two. We'll see if we can get there. But first, I'm going to let this distinguished group, and really all kidding aside, just really, really honored for me to be up here with this panel. I do work in the space with Titan, and I can tell you we have the all-stars here of the world of impact investing. So I'm going to let them introduce themselves, tell a little bit about their organization, and also what impact investing means to them. I'll first turn to Mark.
Great. Thank you, Andrea. Honored to be here with you, Andrea, and the great team at Titan, always in this great panel, and with all of you for the first panel discussion of the week that is not about artificial intelligence. We're going to work it in, though. We're going to work it in. I am managing director and co-founder of A Street. A Street is a growth equity fund, long-dated, focused on solving old problems in K-12 specifically that may or may not be, lead with digital and tech. Old problems that have been getting worse. Problems like the availability of high-quality instructional materials and assessments that matter, and staffing solutions that make teaching easier, as we have all watched it get harder and harder over not just the last 4 years, but the last 40 years. That is what we do. We invest with a lot of flexibility. We show up as a majority or minority. We show up early stage or later stage. We are here to solve a problem. We are in our 4th year, so we are just getting started and have a lot to learn from the people on the stage, and in particular John down the road there, who has been doing this for much longer than we have, and as well as anybody in the world, really. So that's A Street, and a quick then note about this idea of impact investing, which I struggle with, to be honest, and kind of reject. I think the outcomes we are looking for are healthy financial return, to which we are obligated to provide to our limited partners, and good outcomes for students. I think the thing that a market or non-impact investor would say about A Street that is different is that we are on a longer horizon. We are not on a 3 to 5 year horizon. We are a 15-year fund that has lots of flexibility on the backside, and I think that is what an objective observer would say makes A Street impact oriented. If that's true, then so be it. I think it is very hard to get the kind of outcomes we want on both sides of the ledger, impact, good things for kids and teachers, financial returns for our investors, if we're on a shorter horizon. So I struggle with the premise of the definition. I think this is good investing. I think this is what capital should look like in this space. and I look forward to talking about that today.
Thank you, Mark. Hello, everybody. Ana Maria Aristizabal, co-founder of Winnipeg Ventures. Thank you, Andrea, and the GSV team for inviting me to be here. I've been in the impact investing space for 14 years. I've been teaching impact investing for the past 6, and I look forward to the discussion. Over the past 18 months or so, I've decided to create a new fund to fill a gap in the Latin American market, where there was no specialized investor tackling the opportunities in the future of work and future of education. And there was a huge need and opportunity. I don't know how many you are familiar with, but in LATAM, like 4 out of 5 kids do not understand a simple text at the end of 5th grade. And we are lagging behind in many of the indicators, like later on, in terms of PISA and like you name it. So, but it starts really early. So I thought I needed to like bring some of the tools and learnings I had gathered from the years working in the States and like seeing the edtech ecosystem here in the US grow, and bring in some of that and actually think about the future and how could I create an early stage tech fund to invest in these solutions really, really early, like pre-seed, seed, small tickets, with the goal of being a lead investor that was going to be able to catalyze more capital to the industry. It's just, there's a significant dearth of capital to venture and to impact investing, and even much worse into the education space. So my goal with building this fund is like creating this ecosystem and like creating more dynamism, and hoping to collaborate with many of the folks here, and especially those that are investing globally, to build companies that actually really work. So to Mark's point, like, yes, I agree that good impact investing is investing that works. And I want to invest in those companies that are actually transforming the way that learners, teachers, parents, workers interact with technology. And I feel a great responsibility being an early stage investor on like what's the tech that I found, and more to come on that front.
Thanks. My name's Joe Watt. I'm the managing director at ECMC Group's Education Impact Fund. For those that aren't familiar with ECMC Group, we're a national nonprofit focused on post-secondary success and access in the U.S. We started 30 years ago as a guarantor partner for the Department of Education, and have expanded in pursuit of our mission. Over the years, we launched a foundation that has become one of the largest philanthropy arms focused on post-secondary in the U.S. And then 5 years ago, started building what is now our Education Impact Fund, which I have the privilege to lead. And really, our fund has 2 goals. It's drive impact aligned with our mission, and drive risk-adjusted financial returns that we can funnel back into the fund. We try to bring the strength of the ECMC Group platform to bear through the fund in a few ways. One, really flexible capital. We are investing off our balance sheet, and so it provides us the flexibility to come in very early, come in later stage, lead, follow. We started an accelerator program because we felt like there was a gap at that part of the market at the top of the funnel. And so we try to bring that flexibility to bear to fill the gaps in the market that we feel like where we can deploy capital. It's a very patient vehicle, similar to the folks at A Street, where we are an evergreen fund. All of the returns go right back into the fund. And the idea there is patient capital to see those outcomes through, versus trying to or being forced to return capital to investors to optimize for IRR, and having to sacrifice outcomes. And then the last piece, and this sort of goes into how I think about impact investing. I would agree with the comments that have been made already, but for us, how we think about it is not just impact measurement, but actually really leaning in to support and accelerate the actual impact outcomes that are tied to value proposition, because that ultimately is what's going to create the sort of circularity of impact and return that I think is at the core of impact investing. And in this space, in education, I think what we're going to talk about, outcomes and financial returns, in my view, are you can't disconnect them. But I think we really try to take the proactive approach of really leaning in and supporting our portfolio companies and the folks that we work with to drive those outcomes forward, versus just sort of measuring in a lagging way and that sort of thing. So really excited to be here and for the conversation.
Hi, I'm John Rogers. I help to lead education sector investing for TPG's RISE fund. In the US and around the world, we're about $2.75 billion in our third fund. And I'm in a terrific seat because I get to work with terrific executives like Kate Eberly-Walker of Presence Learning in the US and David Leatherborough of Outcomes First Group, well named, in the UK. And terrific colleagues like Tammy Chen, one of our principals who's there in the back. So if you really want good answers to hard questions, ask Tammy at the back. And since I'm in the caboose here of the train and I only get to speak after all of my colleagues have said really smart things, I'll just try to be controversial. That'll be my role.
It's really hard for you, John.
So, so Andrea, who I love and respect and is one of the great experts on the sector, but I really don't agree with the idea that impact investing is all the rage. Quite the contrary. I think that I work for a fund with a mandate that most people don't actually believe in. So I think for the most part in the educational or philanthropic world, folks who believe in impact don't think you can have financial returns if you're committed to impact. Folks, conversely, in the financial world who are focused on returns don't think you can have returns if you have impact. So we're all in this little tiny intersection of these two sets, but they're big sets. So if the intersection gets larger over time, that's going to be a greater and greater pool of capital committed to this strategy. And in some ways, it's surprising to me that there is so much skepticism, because to me, impact investing is just a much better strategy, especially in a sector like education, where if you put the outcomes front and center and let that drive your financial return, you're building sustainable growth and quality for the long term. It's just better, from an investment point of view, because you're sorting out low quality, you're sorting in high quality. It's better as an investment strategy because it's so aligning with the management teams. But it is very difficult. It's very difficult for investors in a 4-hour board meeting not to spend 3 hours and 45 minutes talking about the next 58 basis points of EBITDA margin improvement. It's very difficult for entrepreneurs when they're raising money not to just focus on the last dollar of the current transaction versus what's really going to build quality over the long term. So we can talk more about that as we go along, but I think it's a superior strategy because of the alignment.
John, thanks so much. Thanks to all of you. So now that we've rejected the term impact investing, I'm going to start saying investing with impact when I leave this panel. And I'm going to not say I work in impact investing. I'm going to say I work with investors who invest focused on impact, right? And we all know financial sustainability is absolutely kind of a precondition. We don't want companies that are going to live for 18 months or 3 years and then die. That is not what the goal is here. So investing with impact is our new phrase. So I want all of you to kind of weigh in on, get deeper on some of these lessons learned. Anna, you've been a professor. John's been at this and helped start TPG Rise. Mark DeNovo started A Street. And mention too the size of your funds. John did, but you all didn't. And Joe at ECMC with this enormous flexibility and this evergreen fund, completely interesting, unique idea. So tell us about the lessons learned and how that helps shape how you approach, the matchmaking or the evaluation process, both pre-investment, through the the actual due diligence and investing, and then even post-investments. What are some of those lessons learned? Anna, do you want to start? I mean, I know as a professor, you've kind of, looked at a lot of case studies, but also had experience yourself.
Thank you. And I'm going to add controversy to the controversy. I don't think that we are not saying, I consider myself an impact investor.
Me too.
I do agree with John that the space is still too small. It could be larger, and I'm delighted that there is an increasing number of people doing it and taking on this approach. I don't think it's an asset class. I think it's a lens. It's an approach. And I would say that one of the lessons that I've learned, and I'm taking onto this new enterprise that I'm building, this new investment firm, is you cannot become an impact investor. I think you need to be born an impact investor, if you want to do a fund that is an impact investment fund, you really need to think about how you structure it. And it doesn't matter if it's a government, philanthropy, like whatever it is, like I think you really need to think about how are you going to manage the tension between the financial objectives and the social objectives, and you really need to think about what does it mean for like the fund economics, for the type of LPs, like limited partners, investors that you are attracting, for the type of people that you want to work with you, for the type of incentives and bonuses and carry distribution, like all of those things are going to have an impact ultimately on the outcome of the fund. And if we are all in agreement that we want to invest with impact, call us impact investors or not, like we really need to be like maximizing as much as we can for both, knowing that there are trade-offs. I do think that there are trade-offs, and sometimes like we need to be thinking about that, and that's where there is a lot of value for people like us to be in cap tables, because we are going to be able to navigate those trade-offs in a much different way than a traditional investor who's only maximizing for the financial returns. So to your point about screening and the process of investment, for me, is like when I look at a company, like early stage companies that I will be investing in, like for me, it's like, and we just had a panel here about like how obsessed are they like founder team with the product? How obsessed are they with the outcomes? How obsessed are they with efficacy? Like that's what I want to see, and that's what I am also myself. Like as I started like my introduction, like I am building this because I care about changing the reality for millions of people. And if you as a founder have the same obsession and passion for doing something similar with your tech, then you are good for me. And then we start the conversation about the market analysis and the founder team and like the technicalities and all of the capabilities for actually going towards that mission. And that's going to be reflected throughout the investment process and the management process and like how we're going to be. At the stage I invest, like I don't have necessarily always a board seat. I don't have as much way into the governance structure of the company, but I have a lot of influence over the founders' vision and how we're going to build together. So I think that my role as an impact investor is like to make sure that we don't forget about why we are doing what we are doing, and that every decision we are making is helping us advance that ultimate goal and thinking about the compromise that must be made.
Cool. Really cool. Love that. John, let's go to the other end of the capital spectrum. Anna's ground zero.
The big companies.
Go, yeah, and you're majority. So you're buyout, you're the board, you whatever. How are you thinking about it when you get an entity that already has gone through this birthing stage, hopefully with this impact alignment in their DNA? How do you evaluate it?
Oh, yeah, that's a good question. So we do have a pretty clearly laid out, and if folks, there's a Harvard Business School case on EverFi, if folks want to read more about our impact underwriting methodology. But what is helpful, I think, in our relationships with our management teams is by our charter, we're not allowed to invest in companies unless we can show third-party evidence of impact, and unless we can build a social impact valuation model side by side with the financial model that projects that every dollar of investment we make will generate multiple dollars of benefit for the end users, not just society at large, but it has to be for the end users, the students, the teachers, the administrators, the families. And that's a very aligning structure to have to adhere to. So that's a little bit about how we go about it. In terms of lessons learned, I think it's kind of a truism that people ask for advice and never actually take it. So I will give you some advice, but not necessarily believe that. So what would be great is if the entrepreneurs can tell me what's wrong with my pitch that will actually convince them to, and actually there's great entrepreneurs here who've taken the advice. But there's a couple of areas, and I kind of alluded to it before, it's very difficult for the founders and the entrepreneurs and the management teams in the throes of a transaction not just to take the last dollar. And in most of our cases, current shareholders are rolling into the new deal, so they should care about the long-term potential versus the near-term transaction. But I have a very, very, very high end now of folks who have turned down one of our term sheets over a 10 or 15% difference in value. And ultimately, I think even many of them would say have not realized the long-term opportunity that they might have if they'd partnered with us. So I'm not necessarily the right person to be answering that question. Our portfolio company is the right ones to be answering the question. Jesse Woolley Wilson, who's not in this room, but CEO of Dreambox Learning, turned down several other term sheets that were at higher valuations than ours when we invested. She did have a board that was open to enrolling equity and so believed that maximizing the long-term value was helpful, and I think it was a very good case study in building long-term value and the long-term opportunity being so much greater than the near-term transaction. So that's one of the pieces of advice. Feel free to find me on LinkedIn and tell me how I should improve that pitch so people actually believe it.
Yeah, well, look, I mean, we could talk for hours about people who invested in 21 at some pretty interesting levels and maybe now are looking hard at what they did. But Mark, let's go to you because you had a chance and you've been super thoughtful with a deep career in looking at the problems in education through your work with in New York City and being a philanthropist, and you started this fund in this way. So what lessons informed, some of the ways you approach things?
Yeah. Well, in some ways, I feel ill-equipped to name lessons just because we're so new that we really haven't learned shit, and we need to, this is a time for us to reflect on how we've been birthed and come in, and I think I have a reflection that transcends private equity investing. Y'all will disabuse me of this. This work is so much more about trust and vision than it is about finance. This is, and that's, look, when we are in diligence, that is arguably the most important time. That is when we are staring kind of in the mirror at ourselves and our theory of change, and with a visionary leader and acquiring a set of ideas about where that leader wants to go and seeking alignment, and from there our job is to post-investment be a resource and name hard things but build a relationship of trust that keeps that organization focused on the important stuff. I think that is true for private equity investing across stages. It is certainly true of philanthropy. Seeking alignment from the beginning and being damn sure that you're saying no to the right things and yes to the very few chances you're going to have to deploy capital to the right things.
Great, thanks. And Joe, I'd like you to definitely go deep a little bit on a pretty unique structure that you have and the flexibility and some of the lessons or thoughts that spurred the creation of the Education Innovation Fund, and you sit under the umbrella also with a foundation that can also do grant making, and that also provides a very interesting level of possible cooperation and alignment.
Yeah, I mean, I think part of similar to Mark, I haven't been this long enough to feel like I have sort of immense levels of learning and probably more just like observations. But one observation that has very much crystallized for me, I think, is just that part of the reason why there is skepticism around impact investing, particularly probably at the earlier stage end of the spectrum, is that we just haven't proven out the theory. I mean, there's this theory of impact outcomes equal better financial returns, but I don't think there's a lot of rigor behind the evidence for that at this point. And what John and team are doing is incredibly impressive at that stage. I think it's harder to do that given with earlier stage companies, but I think that's the direction and sort of the push that we as investors need to make, and that's where I think our structure allows us to do that in maybe ways that others can't for whatever reason. We've got a foundation, we've got a immense amount of track record working in third-party evaluation and grant making, and basically bringing capital across the spectrum of risk and returns to bear at a point where companies need it, because it's not linear. It's not like you move from, okay, I have a grant, I have proven my logic model, now I can take venture and I'm off to the races. Sometimes you have taken that venture and you still need capital to evaluate, provide that first or second phase of evidence for whatever it is you're building, to then take it to the next level. And that's where we can pair the grant making alongside of our impact investing. And we're still very early days in sort of realizing that and bringing that, sort of orchestrating that in the right way. But I think that's the potential that has me excited, because I think that's the level of evidence and efficacy that we have to demonstrate to bring later stage big institutional pools of capital to the table and sort of prove out the model.
Yeah, super cool. Curveball, John, I'm going to throw it to you. Impact investing in education is not easy. I mean, education's pretty hard. It's pretty complex. It's pretty fragmented. In the U.S.,
It's a disaster right now.
Okay, thanks. Thank you. Naming it. But talk to me about your broader purview across TPG, because there's climate, there's health, there's fintech, are there other sectors where this has been, I don't want to call it easier, but like the evidence that Joe is talking about, it's more like, yeah, we get it. This works. We can measure the units of carbon that have now been saved, and we can measure the health outcomes, the malaria numbers that have gone down, and what are the lessons learned, and is it just that education is so different, and Mark, undercapitalized? We've talked about that.
I don't think it's so different. I do think it's hard. I think all investing is hard. Education sector is hard, and my flippant comment about being a disaster. We're going through a horrible time right now, as folks know, in K-12 with learning loss and social and emotional issues and chronic absenteeism, and money is flowing out of the system, and it's a really, like, our entire country should be running, screaming in the streets about how bad things are. So that's one challenge. And then you've got the challenge of regulators that are kind of, whipsawing entrepreneurs back and forth with changes in regulation. So that makes it very hard, because any uncertainty can make things difficult. And then I do think it's a sector, I compare it in some ways to healthcare 30 years ago, where there was on the one hand a lot of skepticism about for-profit models. And over time there have been demonstrations, and there have also been great training grounds for leadership. I think one of the challenges in the education sector is there's very few great training grounds for leadership, and ultimately this is such a human capital driven business, so it really does come down to that. Places like Kaplan, which is where Kate cut her teeth, and other places like that are good training grounds, but it's really exceptional. But we don't have to have the easiest sector or the best sector. We just need to find the next great investment and the next great investment, and put one foot in front of the other. And we have to keep the bar high, because, back to my comment about skepticism, folks are going to be ready to pounce and pull their knives out at any evidence that impact investing doesn't work.
Thank you. And yeah, let's John's right about the ecosystem. We all know that, but let's stay optimistic. Every time, I've been coming to this conference for 10 years, and the best thing is walking the halls and talking to entrepreneurs and just seeing those great ideas and the great people. So we are there with you, and you're on the front lines.
And let me add to this.
Yeah,
so
please.
I think, when I think about, climate investing, I'm jealous of the gigaton challenge, that there is this one measure. And I think we can just take a breath and accept, frankly, what we all know. I mean, you all have been at this for decades. There's 1,000 years of experience in this room. What do we know? There is no magic silver bullet. There is not one thing that's going to make everything better. That is better, worse. It's just more complicated. It means certainly we need every entrepreneur and every new idea, and we need to be, as John says, putting one foot in front of the other.
Can I add? And I also think that the climate space and climate investors are just not hiding behind this one metric, this is insufficient, let's not do more investing. They're just doing it. So like, it's also a push for us as education investors. Like, let's just try to find the gold standard of what we need to measure. Just do good investments, track the good indicators, and like we later can continue to track data about what is working or not.
Thank you. Absolutely. So, advice to entrepreneurs. Joe, why don't you kick us off? John gave you a little bit already, but what advice would you give the company CEOs, entrepreneurs in the crowd?
I mean, with sort of relevance to this conversation, I think it's just alignment around values and outcomes at the outset. I think it's an incredibly intimate and long relationship that you have with your investors, good, bad times, challenges, sort of all sorts of different gyrations. And so I think if you're not ultimately aligned from a vision perspective and from what you want it to be over the long term, it's just going to be an incredibly rocky relationship. And I think the other thing that I would just add is understanding that even though impact investors are very much oriented towards the educational outcomes in this sense, or in this space, but recognize that they also have outcomes from a financial standpoint and from an impact standpoint that they have to solve for. And so just because someone is an impact investor does not mean that they are concessionary. And so I think it's just important to sort of approach the relationship with that level of empathy in the same way you would with a customer or with other partners in your business.
Great.
I do have more advice.
Yeah, please. Go right at it.
This won't be for the entrepreneurs, although I will mention in my comment about training before, I should have also acknowledged David Leathenborough came out of healthcare into education, which I think is a good model. Folks like Yuri Weinberg at Teachers of Tomorrow came out of DHL and places which were very data-driven before coming into education. So hopefully more and more folks will also come into the education sector. And the advice for younger folks that also gets ignored, but who are thinking about their careers, if you are coming out of college if you're coming out of college and you want to work in impact investing, do not go work for an impact investor. Get trained in being an excellent investor. And nobody wants to hear that advice, but that is the best way over the long term to be a great investor, is to get rigorous training in good institutions, and then you'll have the opportunity to do impact investing at scale and have greater impact. I like to say that Wynton Marsalis, does anybody know what he won his first Grammy for? It was for an album of Mozart trumpet cantatas, because he wanted to demonstrate that he had the chops to play classical before he could play jazz. So that's my advice to younger folks and folks thinking about their career. Learn the technical chops, and then you can go and play jazz and do great things in impact. More advice.
Mark.
Yeah. Well, 2 points. I'll come back to something John said earlier. I mean, the most important advice is play the long game. Shiny objects, lose their shine. So you're starting something that's going to be around for a century. That's how you have to think. And if you're not thinking that way, then you're in the wrong job. And taking the extra 15% or whatever, or that term that you think is shiny, what is the trade-off? And be sure that you can, you're inviting this investor into your living room, and they're going to be there for a while. So be sure of the alignment and be careful about the trade-offs. I would then say, just quickly on the substance of where we need innovation, I would say it needs to be in the K-12 context. We would argue toward not just something that's good for the student, high quality, something that is coherent for the educator. We have ripped our teachers in 1,000 directions. They need an experience that coheres around that thing that is high quality. And there is, just to name AI for the first time in the last 40 minutes, it is an exciting moment. We should be excited. We should also be thinking about the lessons of of the late 90s and the dot-com, about of the harm done to the educator in that moment. We have an opportunity to learn from that here, and I hope we do.
Thank you. Anna.
On the advice side. So just to make it very concrete, I think it's like for the new entrepreneurs raising early stage rounds, seed, pre-seed, the most important thing to build on Joe's point on the alignment is like, look at what those funds have invested in. Like, can you look yourself and like see yourself in that kind of company they have backed? Like, are the kind of founders and companies that they are supporting the kind of company that you are representing? And if there is, then that's a good investor. Like, it's an easy litmus test for you to like figure it out, because it's hard to test values and like all of these big things we're talking about. But at the end, it's like, can you enter into a marriage for like good 10 years if you decide to go for equity? And before even going there, like, do you really need venture capital money? Do you need equity? Like, are you better off with just raising some recoverable grants or venture debt or like any other type of instrument? I think sometimes like we glorify venture capital and equity investors, and like there are so many other routes. Like my brother is an edtech founder, and he has proven to me that venture is not the only way. Like bootstrapping is a really great way of funding, and later there are other type of investors who can extend your runway and don't have to sell your company so quickly. So this is against me because I want to invest in your companies. But just be thoughtful about the process of getting funding.
Very interesting. Thank you so much. All right, we've got about 3 or 4 minutes left, and I'm going to just get a lightning round here. And we're going to flip it, and I'm going to ask these folks to talk about the advice they have. I know we don't have a lot of funders in this crowd, but you all can go out and tell funders what you think they should be thinking about, so they get, I mean, some of it I think we've heard, but so that they can invest with impact or become impact investors.
Oh boy.
Good luck with that.
Go ahead.
Well, many founders, their time frame just doesn't work relative to any kind of transaction that's going to be helpful to an entrepreneur. So that's one of the big problems. I think philanthropic funders can do fantastic work, though, around research and proving out interventions, and then should use the private sector and government to scale. And wow, there's just a not great interactions between government and the private sector and philanthropy, which is too bad because it's hard to really scale the right solutions without that.
Yeah, I was going to make a similar point, and you know, maybe be specific about, yeah, seek alignment, specifically around IRR versus MOI. Like, how are you going to measure, and how are your LPs going to be comfortable with you measuring what is good? And be sure that that is high fidelity with the asset that you're investing in and the sector you're in, and that it aligns to a broad definition of what is good.
Cool.
Maybe in a different aspect of what we are saying, and maybe it's advice for even all of us, is just this reminder that many of the technologies and companies that we are funding today might end up in the hands of millions of kids and young adults and teachers. And like, we just need to be so thoughtful about the kind of things we want to put money into. And like, we all care about the impact, but I think it's always important to think about when you think about the 100 years that Mark was speaking to, is 100 years company means like hundreds of million people impacted. And what does it mean when we are thinking of the dollars that we are placing? What are the bets we are making? And what are the ethical considerations that we need to keep in mind, particularly now with AI, is like, who are the people behind these interventions, and like what is their logic behind putting these products together, and like how are they going to be thinking about protecting that child in the future when technology gets developed and becomes addictive, and like all of those things. So just an extra reminder.
Thank you. Joe, last word.
Yeah, I mean, I think the thing I would just add is the only way that things get into the hands of millions is if there's scaled adoption, and there's only going to be scaled adoption if there's real evidence that it works, and that's the only way we're going to get meaningful government dollars to the table, meaningful institutional investor dollars to the table. And so I think as impact investors, we have to commit to moving past the just, hey, we reached 6 million students with our portfolio, and actually getting to the level of metrics that are going to drive adoption, and that ultimately are going to bring people to the table to bring those solutions to scale. So that's the point about spending 90% of the board meeting on how do we take EBITDA margins up 50 basis points or whatever, and not, having any discussion around, okay, where are impact metrics today? How do we push them forward in a way that not only is going to, drive excitement around the outcomes, but it's going to drive adoption from customers, which then scale. That to me is the thing that I would just love to see and would be where I hope we can go.